Have you ever wondered how a central bank manages to keep the cost of living stable across an entire continent, influencing everything from your daily shopping to the interest on your home loan? The European Central Bank, or ECB, primarily uses a set of monetary policy instruments to maintain price stability across the euro area. These core tools are main refinancing operations, standing facilities, and minimum reserve requirements. Their careful application helps guide inflation towards the ECB's 2% target over the medium term, ensuring the purchasing power of the euro remains strong. These instruments work by controlling the amount of money circulating in the economy and influencing short-term interest rates. Main refinancing operations are the ECB's primary tool for injecting liquidity, providing weekly loans to banks against collateral for a one-week period at a set rate. Standing facilities offer banks immediate overnight borrowing or depositing options, setting upper and lower bounds for the overnight market interest rate. Minimum reserve requirements obligate banks to hold a certain percentage of their customer deposits with the central bank, which impacts their lending capacity and also helps stabilize money markets. Understanding these instruments helps you grasp how the ECB influences economic activity. When the ECB adjusts its policy rates or the terms of its operations, it sends a clear signal to financial markets and banks. This in turn affects the interest rates banks charge for loans to businesses and consumers, influencing investment, spending, and ultimately inflation. For example, a rate hike makes borrowing more expensive, which can cool down an overheating economy. Beyond these traditional tools, the ECB has also developed a comprehensive toolkit including non-standard measures like asset purchase programs, often referred to as quantitative easing. These programs involve buying large quantities of government bonds and other securities to inject even more liquidity into the financial system, especially during times of low inflation or economic crisis, when traditional interest rate cuts alone may not be enough. These actions demonstrate the ECB's commitment to adapting its approach as economic circumstances evolve. Ultimately, the judicious use of these monetary policy instruments allows the European Central Bank to steer the economy toward its primary objective of price stability. This stable environment fosters sustainable economic growth and preserves the value of savings and incomes for all citizens living within the euro area, underpinning long-term prosperity and financial confidence.